Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me today is Girish Koski, the Managing Director and Chief Executive Officer of PNB Housing Finance. Welcome to the show. A very strong first quarter that you have declared. Profit after tax up nearly 48% on a year-on-year basis. Mr. Koski, take us through the key metrics of the quarter under review.
Good morning, Siddharth. We had a very good quarter in line with expectations. We did pretty well on top line, on the margins, on bottom line. I think all the key parameters are up there for us to see. Only thing is quarter one is there's a bit of seasonality, and because of that, typically in quarter one the growth would be slightly muted, and asset quality generally for most of the companies the GNPA would go up. In our case, it was few bits lower. So I think considering the seasonality, I think quarter one and all the parameters we have done pretty well, and now we are ready for growth.
Since you say that you are now ready for, I'm assuming, future growth, what's your sense about the forthcoming quarters and link it to the overall sort of trends that we are seeing in the housing finance market?
The market is quite robust. Real estate space is doing well since last 2.5 years. Immediately after COVID, it started recovering, and I think till now, looking back, in spite of interest rates going up, to an extent of 225 bips, the demand has not gone down. There has been, some reports on affordable demand slightly going down, but I think overall it's pretty good. And if you look at this year as well, the industry should grow in the range of 12 to 13%, and we are targeting growth of 17 to 18%. And in terms of disbursement, we are looking at growth of 22%.
22% growth in disbursement. Overall, what part of the housing market is generating demand? We have seen luxury housing kind of being the strong theme at play, and affordable housing is not really worked in at least some cities, in the mega cities. What's your own sense about the color and nature of demand?
I think on the prime side, high end and mid segment is doing pretty well. On the low segment, basically it's affordable. There are two segments there. One is income based, and second is informal. So we see bit of fatigue on the affordable informal segment, but on affordable income segment, I think the demand is quite robust. So we see out of four segments, which is super prime, prime, affordable income, and affordable informal. In the last segment, which is affordable informal, that is where we see bit of fatigue, because any company focusing on that segment, I think it's little bit difficult to grow beyond a certain book size. But in the first three segments, the demand is quite robust.
And what is the impact of the interest rate hike cycle that we have seen almost 14 months? We've seen close to 250 basis points increase in interest rates. Is that impact also playing out in the market?
I think the demand, what we are seeing is net of interest rate hikes, and also increase in construction cost. So increase in interest rate and increase in construction cost is deterrent to growth. So what demand we are seeing, what growth we are seeing, at least last year, what we saw for the industry was pretty good. So I think all that is baked in. So now quarter one is typically muted because of the seasonality. Otherwise, the growth is intact.
Okay. What about pricing? Since we are talking about the housing market, how much of that is a issue? We've seen prices go up. Developers have claimed that input costs are partially responsible, uh, and especially in the metros, we are seeing a significant increase. Do you see prices being a factor in the near term? And is there any sense that you get that prices are going to at least stabilize, if not drop?
If you look at the developer business, sale of flats, even that's on the uptick. So construction prices have gone up, but that happened, in last about 12 to 15 months time. So we've seen that last year. So in spite of that, we've seen a lot of developers putting up good numbers. That had an impact. I think even that is absorbed. So I think going forward, at least the price should be stable. I think if everything is where it is, as is, the demand should be pretty robust, and even the developer fraternity will do well in terms of sale, and this is across all segments.
Since we are speaking about developers, what's your strategy in terms of your lending book? The retail loan book has grown by 11% on an annual basis, while the corporate side seems to have reduced by almost 45%. Is that because you are kind of staying away from developers?
Yeah, I think it was a conscious call since we had challenge on the asset quality, especially in the corporate book. So it was a conscious call to degrow corporate book and resolve stressed assets. So we are on course. We plan to start corporate business, but we are not in a hurry. It might take few quarters. But as of now, the focus is very clearly on retail. So our plan is in terms of growth and profitability is based on our retail growth in future, which is both in prime and affordable segment. Corporate is important as a segment. We would not be away from corporate. For a short time, we'll be away. I think when the time is ripe for us as a company, we would get into corporate, but that is few quarters away from now.
What has helped you cut your the gross NPAs? We've seen a decline by almost 259 basis points. Where has this recovery come from?
So actually, what drop we have seen in Q1 is the lowest. It should have been much higher than this. Given the seasonality, I think the drop in GNPA also, has had its part given Q1. I think going forward, this number also would see a drastic improvement, and this is largely from retail. So in corporate, compared to last quarter, there has been no much change because the number of accounts which are two in NPA remained as two. So we are working on resolution out of these two accounts. Out of these two accounts, out of the total GNPA of 856 crores, one account constitutes to about 92%, 90 to 93%, and this is just one account which is backed by a leading developer. So not much of change on the corporate side. Whatever improvement we've seen in Q1 is entirely on the retail side, and this is across all products, all geographies, and this would continue. Q1 was muted. I think going forward there'll be huge lift in efficiencies, on the asset quality side.
You spoke about disbursement in an earlier answer. I just want you to sort of talk about it a bit more. Uh, in terms of your targets and the strategy that you are putting in place, what can you tell our viewers?
So see, we are already into prime business. Today we have a book of 57,000 crores. Affordable we just started. I think both the quarters put together we are close to about 400 crores. So I think a large chunk of our retail book is prime. So we have built the wherewithal to build the book at a higher yield, which will also give us a bit of margin and also huge impetus in terms of growth. Now we have got into affordable. So affordable, the entire infrastructure is now ready. We have dedicated 88 branches. We extended the branches to 88 as of June end. So we have 88 branches which is dedicated for affordable. These are in in pockets where there is demand for affordable business. We have a different infrastructure for affordable. The entire team is different, and this team is from affordable space. I think we have built, now we are future ready. I think now from Q2 onwards, no looking back, I think very clearly the story is going to be on retail growth and improvement in asset quality. So we've built, we've strengthened our distribution. We have done correction in terms of geography. We have tweaked the policy, certain processes to ensure that the book, what we're going to build in future is pristine, and early warning signals are very, very encouraging, and it is in line with what we expect. I think very clearly, I think now the infrastructure is ready both for prime to further improve on growth and asset quality, and on the affordable space to kickstart growth in that space.
Since you're talking about expansion, is there this expansion focused on the tier two, tier three markets? Where is this growth expectation focused on?
Actually, if you see in last few quarters, a focus more on trying to set up affordable business. If you look at affordable business, it's available in metros, top cities, and tier 2, 3, and 4 cities. I think the beauty of this segment is that there is an opportunity even in metros and big cities, and also, of course, tier 2, 3, and 4. So our expansion also has been on similar lines, though we are more present in tier 2 and 3 cities, but we are also present in big cities because that's where we see a lot of value. And if you look at entire affordable potential, I think what top 20 cities can offer is about 50%, and the next 100 towns can offer 50%. I think that's the kind of mix what we see between top cities and next 100 cities or towns. And therefore, no, we are present in all these cities.
You also completed a rights issue close to 2,500 crore almost. Where are the proceeds going to be utilized?
I think as you speak, we have very less amount to be utilized because the entire amount was for business growth. So that proceeds have been are being used for disbursements. It's hardly about 2,500 crores, and it is not even probably 75% of our quarter one disbursement. So we utilized most of it. Whatever is left out, that we'll be utilizing in this month and next month. I think it was complete. It was meant for business growth, and that is the use. What we are going to do.
Given your plans, do you see the possibility of having to go out and raise more funds in the near future?
Oh, not at all. Not at all, because our capital adequacy is now 30% and DR is less than 4 times. It's about 3.83. So for next 3 to 4 years time, I think we see there is no need for us to raise for the capital. And what capital we have now with the infrastructure, we'll be able to grow at the desired rate.
Mr. Girish, since we are winding down this conversation, I just want a broader comment from you on the interest rate cycle that we have seen. There are signs that we could be in an extended pause, and at some point, circumstances may push the MPC to even consider a cut. What's your own sense about where the interest rate cycle is placed currently, and what can we expect in the next 6 to 9 months?
I think the rates went up in last 4 to 5 quarters. So now it is a consolidation phase. Maybe for next 2 to 3 quarters, it will consolidate. It will remain where it is. And after that, probably it might start coming down. But I think it will start with 25 bips down. So I think for next 3 to 4 quarters, it's going to be a good story for NBFCs and housing finance companies, because in the interest rate rising scenario and the consolidation stage, I think all the NBFCs and HFCs will do well. So which is little different vis-a-vis compared to bank, but at least non-bank would do well. The interest rate increasing. When I say increase, not substantially, I think to a certain extent, and during the consolidation stage, HFCs and non-bank companies would do well. So I think given that in that context, next few quarters are going to be really good for the space.
Absolutely, and the share price also reflecting some of that optimism that you've just shared with us, Mr. Koski. Thank you very much for your time with us today. We'll be back with more viewers. Do stay tuned in. It's a wrap on this discussion where we decoded the PNB Housing Finance first quarter results. Bye-bye.
ICICI Bank, Kotak Bank, AU Small Finance Bank, Yes Bank, all of those as well. And Reliance Industries have already talked about. So largely the set